With 30-year mortgage rates continuing to make new highs, housing seems to be in the news everywhere you look. Let's talk about a few of the underlying trends now. Hi, my name is Eric Blattner. I'm with Divvy Wealth Management, and thanks for watching. Before we get too far, please make sure to subscribe to our YouTube channel to follow along with our content and receive all of our updates. Or you can go over to divvywealth.com, that's DIVVI wealth.com, and sign up for our blog there to make sure that it hits your inbox, typically about once every week. So with that, let's turn our attention to housing. And um, obviously, inflation and interest rates have been the top of minds for folks really for a year and a half now. And I'm recording this, Thursday, August 24th. Mortgage rates hit 7.23% today. And this is the highest rate, the 30-year mortgage rate. It's the highest the 30-year mortgage has been since 2001, over 20 years. And so let's talk about the impact. The first trend, I guess, that we wanted to identify, and we're really going to talk about three things in particular. The first is affordability. And the National Realtor Association publishes an affordability index. And essentially what it's trying to gauge is can the median income family afford to borrow or qualify for a loan that would allow them to buy a median priced home? So the chart here shows historically what this affordability index has looked like. If the number is right at 100, that essentially means that that median level income can qualify for that median priced home, the loan for that home. And right now we're at about an 83. So rising interest rates, rising mortgage rates have really taken a bite out of affordability. That's the first piece of the puzzle. I think everybody's aware that the cost of borrowing is a big deal for housing, but to put a little bit of context around it, here's a table that just outlines one very broad, generic example. And we just took a look, assuming there's a family that wants to buy a $500,000 home. And like most people, they put 20% down. They're going to borrow for 30 years. And then I estimated property tax and insurance to be about $7,500 per year. So whether that's high or low is debatable, but nevertheless, that's what we're using here in our assumption. And the only variable that we wanted to include here was the mortgage rate. And so right now we are at 7.2. I went ahead and juiced it a little bit just to kind of make the point, I guess. And there's some calls that these rates may be moving up in the future. I'm going to stay away from the prediction game, but nevertheless, we used 8% in one scenario and then 3% in the other scenario. And essentially what that meant is that the affordability, you need roughly 50% more income to be able to qualify for that loan. And the way that we back into that is that as a general rule of thumb, and again, this is just a rule of thumb, not a hard and fast rule, not etched in stone. We typically don't want home debt to represent more than 28% of someone's pre-tax income. And so in the first situation on that 3% mortgage rate, you would essentially need $100,000 to be able to afford the monthly payment. And that includes principal, interest, taxes, and insurance. And if on the other hand, we were looking at that 8% rate, you need an extra $50,000 in pre-tax income to make that ratio work, to basically get to that 28% threshold. So when we talk about affordability and the impact of interest rates, you can see what we mean. Now, if you don't like the example that we used, I'm going to include a link, or if you're reading this on the blog, there's a link in the blog to a mortgage calculator. If you're watching this on YouTube, down in the description, there will be a link that takes you to a very basic mortgage calculator where you can input your own variables. You can adjust the purchase price, the down payment amount. You can adjust how much you want to pay for property tax and insurance to try to gauge the total monthly cost, as well as the minimum level of pre-tax income needed to be able to afford that type of home and the loan associated with it. So affordability is the first piece. Again, affordability is essentially at its lowest level in about 40 years. So this is the impact that interest rates have. We lived through this environment through the 2010s where interest rates were extremely low and homes were very affordable for a lot of folks. And as those rates have gone up, the cost of borrowing has gone up. It's certainly taken a bite out of affordability, which is a good segue into the second piece, which is supply. And one thing I think that immediately stands out when you look at that period from 2009, 2010 through 2021. I think we'll look back on that period and say that it was at least one of the defining characteristics was really low interest rates. ZIRP, zero interest rate policy, became an acronym that a lot of folks were all too familiar with. And now that we are here toward the end of 2023, or at least the back half of 2023, I think there may be a little bit of recency bias for us, thinking that interest rates are certainly going to go back to where they were in the mid 2010s because that's what we were used to. Well, I think if you kind of zoom out and take a longer term view of interest rates, we'll recognize that that period may have been the anomaly. There haven't been too many other periods in history where interest rates were anywhere close to that low. So we'll come back to that in just a minute. Getting back to supply, I'm going to show a couple of charts here. And the first is going to show the chart on the left here is going to show mortgage refinancings. And that's the dark green portion of this chart. And in case you can't read all the detail, I'll just tell you that there were basically $6 trillion worth of home loans that were refinanced from the beginning of 2019 through the end of 2021. 6 trillion. Big, big numbers. And that's that spike that you see right there around COVID. Refinancing have been a big part of the game for a long time, as interest rates have really been from the early 1980s until here very, very recently. Interest rates had been in a steady downward march. And, over the last 5 years before 2022, there were millions of Americans that refinanced into ultra low mortgage rates. And how does that impact supply? I'm a perfect example. I refinanced during COVID, maybe right before COVID. And it would have to take a very, very special situation for me to move, for me to leave this mortgage behind and go somewhere else, because obviously I'm going to have to refinance at a much higher rate today. And that's just not very interesting to me. I really like my cheap debt. And I think there's millions of other Americans that feel, quote unquote, trapped by these ultra low rates. So essentially what you're seeing is you're not having a lot of existing homes come onto the market. Existing home supply as a ratio of total home inventory on the market right now is at its lowest level in recent history, maybe ever. The Wall Street Journal, linked to this article as well, reported about a month ago that the percentage of the market that was being made up by or that was accounted for in new homes, new construction, was about 30%, which again is very, very high by historical standards. Typically, it's around 10 to 20%. It dipped a little bit below that following the financial crisis in 2009 and 10. It was a little bit above that during the housing boom. But generally speaking, kind of that 10 to 20% range has been the more of the norm. And right now we're 30%, if not a little bit north of that. So there's not a lot of new or not a lot of existing supply coming to the market because of those, at least partly due to so many folks that have refinanced, locked into really low rates, and are very reluctant to move. So that's actually been pretty supportive of housing prices and real estate prices, even in the face of rising interest rates. I'm sure that probably has a breaking point. Don't know exactly what that is, what interest rate would cause the housing market to break, but so far it's been pretty darn resilient. The other piece to this story is really about home builders, and it's been a good environment for home builders to step into that gap and try to fill the void, try to help meet the demand that's there. Zillow just reported that buyers surveyed between April and I think it was June or July of this year, roughly half of those buyers were first-time home buyers. Again, kind of supporting the narrative that existing homeowners are not on the market. So a lot of this demand is really coming from first-time home buyers, and builders in particular are stepping in to really meet that demand. That's shown up in a couple of places. The home builder ETFs have had very strong performance year to date. And there's some big name investors like Warren Buffett and David Einhorn who have been talking about the attractiveness of home builders in this market where there's a fundamental mismatch between supply and demand. So something to keep an eye on. That's kind of the second trend is limited supply. And then lastly, rates. And rates, I don't know that it's a trend in and of itself. It obviously impacts all these other aspects of the housing market. It certainly goes hand in hand with affordability. But I guess my comment on rates is now that we're at about 7.2% on a 30-year mortgage, it wasn't that long ago when, you turned around and you were on social media, there were a lot of influencers talking about, don't worry about that ultra high or ultra high. Don't worry about that higher mortgage rate. I'm not going to call 6 or 7% ultra high, but don't worry about that higher mortgage rate. Just go ahead and buy it and refinance it as soon as rates go lower. Almost an assumption that that's where we're going. That's where the market is heading. And I think, from our perspective, two things: interest rates and the direction of interest rates are notoriously difficult to predict. Um, we are at, as I mentioned, 7.2% on a 30-year mortgage right now. That's as high as we've been in over 20 years. And maybe we do get back to ultra low rates that we saw in the mid 2010s, but maybe not. So I think what we would suggest for home buyers or folks in the market right now is don't buy a house that you can't afford today. Don't automatically assume that those rates are going to fall and you're going to be able to refinance in 6 or 12 or 18 months. If you can't afford the payment that you're buying into today, it's probably the wrong house for you. And I guess the punchline there is we may not be entitled to a sub 3% mortgage rate. And the environment that we lived through the 2010s, um, it may become more common knowledge or I guess shared conventional wisdom that that period was the anomaly rather than a 4 or 5 or 6% interest rate environment going forward. Only time will tell. Until then, I think it's been obviously a very interesting market. There have been housing is an important part of the financial picture for so many individuals, and we hope you find this helpful. In the meantime, again, please follow along at YouTube, divvywealth.com. Follow us on our social medias and get in touch if we can help. Thanks.